Hello everyone, this is Shlok, and in our endless interview prep journey, we stumble upon news surrounding the budget. Then we hear how Donald Trump is imposing tariffs on his neighboring countries, and we also hear how the stock market is going up, down, and haywire. The key to appreciating these diverse phenomena lies in simple understanding of basic economics. So first we'll be covering the stepping stones of economics, which are demand and supply, and then we go on to discover how major economic policies are formed. With that said, let's get into it. So the first aspect that we'll be dealing with is the law of demand and the law of supply, and I know a lot of my peers from the commerce stream are going to be very well versed with this, so I'd advise them to jump to this particular timestamp right here. And as for the people who are still here, let's get into the law of demand and the law of supply. So while the law of demand and the law of supply might sound intimidating in the first glance, because that's what was the case for me as well, but if I tell you what the statement is for the law of demand, you'd be shocked that there's a law by this name. So the statement is fairly straightforward, that as the price increases, the quantity of any particular commodity that is demanded at that price goes down. For example, if the price of an iPhone increases, less and less people are going to buy that particular phone, and that seems like common sense to us. Why is there a law surrounding this? But let's get a little bit more into details surrounding this. And the law of supply is similarly something opposite to it. So let's say the price of an iPhone goes up, the suppliers would be more willing to supply more quantity of that particular commodity because they'd be able to make more profit margins. So that's a very straightforward law of supply as well. But let's take a graph in order to understand this in more detail. So right here we have a straightforward y-axis and then an x-axis, and on the y-axis we have the price, on the x-axis we have the quantity that is demanded. All right, so once we have this graph drawn down, we just have to create a downward sloping line. What is this downward sloping line? This is called the demand curve. And what is the demand curve? The demand curve is a graphical representation of the law of demand. And how does it represent the thing that we've just talked about? Let's see. At the price of 6 rupees, the quantity that is demanded of any particular commodity is 10 units. Then when the price of the commodity falls to 5 rupees, 20 units of that particular commodity are demanded. So you can see that as and when your price is falling, the quantity that is demanded of any particular commodity is rising. As you can see in daily life as well, whenever there is a Flipkart sale on iPhones, the iPhone that was earlier worth 70,000 or 80,000 bucks is now worth 50,000, and a lot more people are lining up in order to buy that particular product. So that goes to show that the law of demand actually works. Now looking at the law of supply and the supply curve, fairly straightforward, just opposite to the demand curve. It is an upward sloping curve. But why is it an upward sloping curve? It's something we've already discussed. As the price that, let's say earlier the price was 1 rupee, only 10 units of that particular commodity were being supplied by the suppliers in the market, because as the price is lower, there is less incentive for one to sell that product. But as the price increases, the suppliers are willing to sell more and more of that commodity in the market, and that is why the supply curve is an upward facing curve. And now I want to come to the most interesting aspect of the discussion. The real magic happens at the juncture of these two particular points. And what is happening at the juncture? We get the equilibrium price and we get the equilibrium quantity. And what is this equilibrium blah blah? The first important thing is the equilibrium is what the market decides the price of that particular good would be, and the equilibrium quantity is the amount of quantity of that particular commodity that will be supplied to the market. And why is this the actual thing that happens? Is because at this exact spot, the quantity supplied and the quantity demanded are equal, and there is no excess demand or excess supply. Okay, again, a lot of jargon, I understand, so let's break it down further. Let's understand that what if the price was any other apart from the quantity, apart from the equilibrium price, if there were any other price which is the final equilibrium price, what would happen? Let's say the equilibrium price is 1 rupee. What the thing that would happen is that the quantity supplied at this particular rate is just 15, but the quantity demanded is all the way here. More than 60 units would be demanded. So what happens over here is that the buyers would say that, okay, I really need this commodity, I am willing to pay more for this. So what happens is the price goes up. And let's say if it were the other way around, let's say the price was very high, at that point the supply would be very much, but the demand would be very low. So the suppliers would be willing to bring the cost down because they want to let go of their product and they want to sell it off. So that is how we approach this particular equilibrium point. Once we have our basics of economics clear, which is the law of demand and the law of supply, and understanding how the market prices a particular commodity, we can go on and understand how inflation works, which is sort of a huge extrapolation if you ask me. First, we understood how one particular commodity is priced, but now we can understand how inflation, which impacts the whole economy, works. So let's get into that. So before understanding anything about inflation, we need to understand what is the concept of money supply. Again, sounds intimidating, but is fairly straightforward. Money supply is basically all the amount of money that is available in the economy at any given particular point of time. And why is this money supply important? The money supply dictates how much money is available in the market that is chasing the amount of commodities that are there. For example, if there are a certain amount of commodities in the market and there is a lot more money than there used to be, the overall prices of the commodity are going to go up, because more and more money is going to be chasing fewer and fewer goods, and that would create a sort of scarcity, and that, as we all know, only drives the prices up. So the first very important aspect is that money supply becomes a key area that dictates your inflation levels. Now let us look at how this money supply is controlled in order to control the inflation levels in the market. For example, we've all heard that the RBI changes the interest rates in order to control the inflation levels. That is something we've all heard, but now we are going to understand how the mechanism behind that really works. First of all, what are these interest rates that everyone keeps on talking about? The interest rates is basically an umbrella term that talks about that includes the repo rate, it talks about the home borrowing rates, and every kind of loan, basically an overall umbrella term that talks about what are the kind of interest rates that an individual or a corporation has to pay in order to avail loan in a particular economy. So it is not exactly the same as the repo rate, but it is very closely related to the repo rate. And why am I talking so much about the repo rate? I think the repo rate is the most important macroeconomic sort of a tool that the central bank, which is the RBI, uses in order to control the inflation in the economy. And how does this repo rate work? First of all, we need to understand what the repo rate is. Repo rate is the amount of money, is the amount of interest rate at which banks can borrow money from the RBI. So let's say, just like individuals who want to, let's say, buy a house or a car, they take loan from commercial banks, but even commercial banks need money, and they go to the RBI in order to take that money, in order to take those loans, and they get these loans at the repo rate, which is, as I said, one of the most crucial rates in the economy. Now, how does this rate impact the inflation levels of the money supply? First of all, what happens is, if the repo rate goes up, which is the rate at which commercial banks are availing interest, which is the rate at which commercial banks are availing loans from the RBI, if the repo rate goes up, the cost of borrowing for the commercial banks also goes up. So let's just write cost of borrowings goes up. Now, if the cost of borrowing for the commercial bank is going to go up, they're definitely going to charge more interest from their own clients, which is regular people like you and I. So overall, what happens is the overall interest rates, that is the overall interest that is charged from everyone for borrowing money, goes up. And what this does is, as the interest rates are going up in a particular economy, the demand for credit is going to dry up. Because right now, let's say I want to buy a house, but a loan is very, very expensive. I'm being charged, let's say, 25 or a 30% interest rate per year. I wouldn't really want to take that loan, and the demand for me to take that loan is going to dry up. So what happens is the money supply reduces. That is one very important part. So whenever inflation is skyrocketing, what the central bank or the RBI in our case does is that they increase the repo rate. What they do is, by increasing the repo rate, they make borrowing more expensive and less attractive. So the overall money supply goes down, and we already understand when the money supply goes down, there is not enough money that is chasing so many goods. So what happens that the prices automatically stabilize. Now, while we are on the topic of repo rate, I also want to touch upon what happens when the repo rate decreases, and I want to link this with the stock market as well. So let's say when the repo rate decreases, exactly the opposite thing would happen, which is money supply goes up, and that leads to inflation. You might think, so maybe this is a bad thing, but the stock markets love it when the repo rates go down. And why is that? When the repo rates go down, what happens is cost of borrowing decreases, as we've already understood. When the cost of borrowing decreases, credit becomes more attractive. And you can understand, if you were a business owner and taking credit has become more attractive, you would go out and borrow as much money as you need in order to facilitate your new business undertaking. So whenever money supply in the economy goes up, your overall business activity in the economy grows. So the stock market really likes that, and that is why whenever there are even as much as rumors of interest rates or the repo rate going down, there are huge strides that the market sees. So whenever the repo rate goes down, the overall economic activity increases, and stock markets love that. Now that we are on the topic of the central bank, I need us to understand what is the difference between the monetary and the fiscal policy. And this, why am I posing this question? This question has been posed to me time and again, at least upwards of 5 times in different mock interviews and actual interviews. Hence, this becomes a very, very important topic for us to discover. And let's just see what exactly the difference between the monetary and the fiscal policy is first of all, we need to understand that the monetary policy are the actions that are undertaken by the central bank, which is the RBI, in order to control the money supply and the inflation in the economy. And these are mainly these are mainly controlled by the RBI by using tools such as the one we've already discussed. There is the repo rate, and there are a bunch of other tools as well that I don't want to list down in this particular video. But there is cash reserve ratio, there is reverse repo rate, there is open market operations, and so on. But that is something that we'll cover in a later video. Let's look at what the fiscal policy is. The fiscal policy is what the government uses. So as we can understand, the RBI and the government are separate entities. The government uses a set of particular operations which come under fiscal policy. For example, what we have just seen right now, the taxation aspect. Now taxation has the threshold of no tax limit has been exceeded. It has been extended to 12 lakh rupees. What this does is it leaves more money in the hand of the people, increasing the money supply, and it will give an overall boost to the economy. So that comes under fiscal policy. This is not something that the RBI can control. This is something that the government controls. So this comes under fiscal policy. In addition to that, we see a lot of infrastructure projects that are being undertaken by the government. That also comes under fiscal policy. So any kind of action that is taken up by the government in order to sort of stimulate the money supply, or to throttle or to control the money supply in the economy, all those particular operations come under fiscal policy. The next very crucial aspect that we need to understand is that of GDP. And why is this important? It is something that we are proud of. We are the 5th largest economy in the world in terms of GDP, after the USA, China, Japan, and Germany. So that is something that we must know about. What exactly is this thing GDP that we are so proud of, and that we have set a target of to become a $5 trillion economy in terms of GDP? So it becomes all the more important for us to understand what the GDP exactly is. So what is GDP? GDP means the final value of all the goods and services that have been produced in the domestic territory of any particular economy in one particular year. So there could be a trick question in this regard, that what if an Indian goes outside India and earns a certain amount of income? And what if he brings that back into the country? What do we do in that case? Is that a part of the GDP or not? And the answer to that question is that it is not a part of the GDP. It comes as a part of the gross national product. That is a different concept that is not tested very much. But the most important part that we need to understand about GDP is the fact that how much is the amount of goods and services that have been produced within the domestic territory. And even if a foreigner comes into India and let's say provides goods and services, that also forms a part of the GDP of India. So that is one very particular aspect. That is the total value of goods and services within the domestic territory of India. That is one very crucial aspect that you need to understand about GDP. The last part of this particular video that I want to talk about is that of the circular flow of money. So you might have heard a lot that when government invests, let's say 1,000 rupees into the economy, the kind of benefit that the economy gets, it's more than 10,000 rupees. And why is that particular sentence said, and why is that statement relevant, is something that we are going to be discussing right now. The first aspect that we need to understand is that of the circular flow of money. We need to understand that broadly there are only two parties in the whole economy. The first is the firms, which are the businesses, and second are the households. So firms are basically businesses which provide employment to the households, and households are the people who provide labor to the businesses. So what happens is, whenever these firms, let's say they are giving out salaries, they give salaries to the households. So money flows this way. And now households, let's say they want to purchase certain necessities, or they want to purchase luxuries. What do? They give this money back to the firms. So this is how your money flows circularly through the economy as a whole. Once we understand this circular flow of money, we can go ahead and understand how the earlier statement works. That is how when the government invests 1,000 rupees into the economy, there are ripple effects, and the economy gains more than upwards of 10,000 rupees in terms of value from that investment of 1,000. So let's discuss that. let's say that the government goes out and says that we are going to build a metro project and gives a certain contract to a company, let's say L&T. Now L&T gets a certain amount of funds from the government, and what is it going to do? It is going to give these funds to smaller companies. These are smaller companies, and it is going to give its funds to its own employees. So what happens is the amount of money supply in the hands of the employees and the smaller companies is going to go up. These smaller companies are going to go on and pay their own employees, and the employees of L&T are going to go about and do their consumption expenditure in the form of purchasing clothes, in the form of purchasing laptops, in the form of education, healthcare, and so on. So and once, let's say, if a particular employee purchases XYZ product, that company is also gaining. So throughout this whole process, once 1,000 crores have been invested into any particular scheme in the economy, it has ripple effects, because this money keeps on flowing through the economy, and it generates a lot more economic value than the initial investment. So this makes one appreciate the value of government investments, especially in infrastructure, because it has twofold advantages. First of all, it creates the infrastructure which serves the economy in the long term, and in addition to that, it also creates these ripple effects that we have talked about in terms of injecting money into the economy and giving it ripple effects, and the money sort of grows in the economy. So those are the two-pronged benefits of government investment in the economy. All right, so guys, for shortage of time, that's about it from my side. I wanted to cover a bunch of other topics such as foreign exchange rate, how Donald Trump is using tariffs in order to control his economy and in order to grow his economy, and what are the sort of pros and cons of tariffs. I wanted to talk about that as well. I wanted to talk about free versus floating foreign exchange rates. I wanted to talk again about fiscal deficits and so on, but that's something that we'll be discussing in another video. If you want me to cover that, please let me know down in the comments below. That's about it from my side, and I hope you got to learn something from this one. Thank you so much, and stay tuned.